Ronald Freeman is a former co-chairman of investment banking at Solomon Smith Barney and head of banking at the European Bank for Reconstruction and Development. These days, he's director of finance at the Atlantic Council, which promotes U.S. leadership in international affairs. So nothing short of a miracle that we got something tangible out of Brussels. Does that mean that you're breathing a sigh of relief? I
am breathing a sigh of relief. In historical perspective, to think that Germany and France have worked side by side, shirt sleeves rolled up, to get this done is extraordinary. But on the other hand, I think Germany, with its own sense of its historical relationship, would not allow itself to destroy Europe 3 times in 1 century. They were going to get this done, and they did.
All right. So what do you say to those who are also now starting to feel perhaps a little bit more cautious, those that are saying, well, yes, they came up with something, and perhaps it was a little bit better when you look at the way previous summits have ended, but nevertheless, the details are extremely sketchy?
The details are sketchy, and they require a lot of cooperation within the EU and from outside the EU. But the momentum is going in the right direction. What they've achieved, Chancellor Merkel, President Sarkozy in particular, with all their colleagues, is very similar to what de Klerk achieved when he let Nelson Mandela out of Robben Island and changed the whole direction of South Africa from an apartheid, hateful government to something open and ecumenical. Europe has done something of similar dimension today, and they deserve great credit.
All right, so you're saying that this is hugely significant that France and Germany have managed to come together and cooperate in this way. Do you think that they can maintain that level of cooperation when the negotiations still have some way to go? Could we see them being held up and bogged down even in political infighting?
We could, Maryam, you're absolutely right. It depends upon goodwill all around, voluntary goodwill. Not just from bondholders who are taking a 50% haircut, but from all of the other suppliers of the capital that's needed to make up these losses.
So, Mr. Freeman, do you then think that there is a chance that some private investors, some of the current bondholders, will not participate in this plan, that they will refuse to have a 50% haircut on their debt?
Well,
holdings?
Another pat on the back goes to Charles de Lara of IIF. He's done an amazing job holding these banks together. Like herding cats, it's very difficult. Some may say no. But so far, people are still signing up. Charles is optimistic. And the momentum is in the right direction. Let's keep it going in the right direction as long as we have it.
I mean, there's no target for participation, was there, in terms of members? We've seen targets before. I think the previous deal agreed in July, there was a 90% participation rate. And I'm just wondering, will there be those who say, well, he shouldn't have done this? You know, it's 50% is much greater than the previously agreed 21% haircut that they were going to take. Are they going to say, well, he shouldn't have backed down?
Some will say that, but 50% is still less than the actual market value of Greek debt today, which is a 60% discount from par. So it's closer to reality, and it means that the banks who take the markdown can get credit for having more truth in their accounting.
And do you think that that will be something that is recognized by investors? Because 106 billion euros of more capital. You know, we were having previous estimates from the IMF putting it at something closer to 200 billion. Is that going to be far enough to strengthen the banks to withstand sovereign debt pressures?
The market, in inverted commas, would like to see an unlimited joint and several guarantee for any possible number. That is simply not realistic. What they've achieved is extraordinary. Let's take it further.
What is the next step? How do you take it further?
We'll get more voluntarism from the banks, and we will get, I think, participation from a group that's been overlooked in all this. Pension funds are totally dependent on being able to achieve a certain rate of return on their assets. Low interest rates have hurt pension funds tremendously. New debt coming out of Italy at 5.5% or 6%. Debt from the new Europe, Russia, Poland, which trades at higher rates, can be of tremendous attractiveness to pension funds. They can participate in refinancing these banks.
You are expressing confidence that all the members will participate, that this 50% haircut on their Greek debt holdings will go ahead.
Under the leadership of Charles de Lara of IIF, so far so good.
And what else are you watching for? Because you were speaking about the pension funds and you're saying that's something that we're not paying enough attention to. Why is that?
Well, because the problem is now beyond a financial or economic problem. It's a political problem. We have in the United States, since the year 2000, we had a projection from the CBO that by 2011, we would be $3 trillion in surplus. And the experts then were worrying about what would happen to the capital markets. There'd be no more U.S. Treasury bonds to trade. Well, that hasn't quite worked out. We are now $13 trillion in deficit. That's a huge swing in 10 years. Where did that swing come from? The war, the tax cuts, the decline in the economy. How do we pay back that debt? It's too much, and it's rising. We need to have a general consensus of a political nature that we need to raise taxes. We need to cut expenses, but we need to raise taxes.
And just, do you think that do you see the markets potentially focusing more on the US now if we do see the details being worked out here in Europe and this optimism carries through and it's backed up by political cooperation, as you're saying, on the part of European leaders? Will it then be the turn of the US to come under pressure in the market, say, towards the end of this year?
You're 100% correct, Maryam. The spotlight, the world's attention will swing back to Washington. This is what they've achieved in Brussels, an amazing achievement. So far, so good. Now, what about you folks in Washington? Can you get together and address your deficit and the bad trajectory the U.S. economy is on?
I mean, I guess the remarkable thing when you look at U.S. borrowing costs, despite the fact that they had a downgrade in their top-rated status, it's just not being reflected in what they pay in the market right now. Do you think you almost need that pressure to happen to be exerted to an extent the way it has been for some of the countries in the Eurozone as a kind of catalyst, as an incentive to do something about it?
Well, that's a very good question. The U.S. continues to benefit from its exorbitant privilege of being the world's reserve currency, which meant that the Treasury could issue what was called quantitative easing, but you and I know means printing dollars without having a good use to put them to get the economy going again. That cannot continue. There is a limit to how much you can blow up the money supply without blowing up the economy, without re-triggering inflationary expectations before growth starts again. That must not happen. Then we have stagflation. That's a problem very hard to solve.
And how much confidence do you have that we will see potentially unpopular policies coming into place, that we will see the debt committee go further in terms of making those cuts, in terms of tax increases, just as we're heading into an election year?
Well, that's the problem. An election year always produces a lot of silly ideas and a lack of responsible governance. On the other hand, we are seeing signs of growth in the U.S. economy, signs of growing confidence. Consumer spending seems to be flattening out. There seems to be a slight pickup in exports. This may give our leaders a chance to focus on what is really necessary now, which is to make some right decisions to get the debt down and the economy back on track. I think that will happen.
So, Mr. Freeman, you've said that you're worried about the situation in Europe right now because there is still uncertainty going forward, and you're saying that it's a political problem and that you're not 100% sure that Angela Merkel and Nicolas Sarkozy will cooperate the way that they have done, and you're also worried about the deficit in the U.S. Which one are you more concerned about, the U.S. or Europe?
It's the U.S. turn now to show political responsibility. The Europeans have shown tremendous political responsibility. Political responsibility will address the economic issue. The U.S., they have a great opportunity to look intelligent. It's been a while since they've done so.
Well, thank you very much again for joining us, Mr. Ronald Freeman, Director of Finance at the Atlantic Council.